Thanks everyone for tuning in today. It is a busy time of the year for most of us, so we appreciate you taking the time to join us. I'm Aaron Klee, General Manager, Investment Management and Services at AMP, and I'm really pleased to be joined by Ben Powell, Chief Investment Strategist at the BlackRock Investment Institute. We're very privileged to have this opportunity to hear from Ben. He is a man in great demand at this time of the year as BlackRock's Outlook is published. In fact, I watched Ben being interviewed on CNBC this week for a global TV audience. So it's pretty cool to have Ben with us talking to our customers in New Zealand. So welcome, Ben. Before we start, let's just get some important stuff out of the way. The information included in this webinar is of general nature and is not financial advice. We always encourage you before taking any action that you should always seek financial advice or other professional advice relevant to your personal circumstances. So today we're going to cover how the year has played out in 2025 and what that's meant for the performance of your AMP funds. And Ben will share his and his team's insights into the key themes for the year ahead, helping you to feel more confident and prepared as we head into 2026. But firstly, Ben, let's look back first. What have been the key highlights or events in 2025 that you are reflecting on that have shaped markets, economies, and politics around the world?
Hi, Aaron. Hi, everyone. Great to be with you discussing the thoughts for what's going to drive markets looking forward. But as Aaron says, it's good to think about what we've learned over 2025 and hopefully take those lessons into next year. So in 2025, I really think the main takeaway from 2025 was the importance of staying invested. So clearly, through the course of the year, there were many things which were didn't just seem scary, they were scary, I think, transcending geopolitics. I'm based here in the Middle East, so a lot of that going on here, not to mention Ukraine, Russia, and so forth. So geopolitical kind of drama are ongoing. The tariffs, genuinely disconcerting moments. And yet, overall, approximately, markets did pretty well, right? So I think the main lesson from 2025, maybe as always, is to really try and stay close to your kind of convictions. What do we really believe? And even more importantly, the importance of understanding that being underinvested is actually a very risky thing to do. So I'll give you the kind of exaggerated example. If you're 100% in cash, people might think, oh, I've got no risk on. But that's a huge trade in the sense that if the market then rips in your face, which kind of happened in 2025, you've missed out on some beautiful returns, which could have gone into funding retirement, putting kids through college, and so forth. So I think the main takeaway from 25 is the importance of staying invested, even in a world where we're seeing news flow driven at the speed of Twitter and so forth. So if we can put up my slide 2 from my deck, staying pro-risk through April's volatility worked well, just to color that in. So you can see back in April, this was kind of Liberation Day, if you remember that. That was when President Trump and the US administration were really kind of, how can I say, assertive, maybe even aggressive or perceived to be in terms of what they were willing to do, disrupting the global economic system, disrupting the global economic trading system, and so on. So I think, it wasn't unreasonable for the markets to at least pause for thought, and that's what happened. So you can see the volatility in April, specifically around tariffing penguins and kind of all of that stuff. There was a real worry, I guess, in the markets for a short period of time that maybe the US administration is very ideologically committed and is really focused on transforming the world and America's position within the world, even if that meant kind of economic and market disruption. So what we got to pretty quickly, though, thankfully, was a realization that even the very, we think they're sincere, right? The US administration, they are serious about trying to change many things. I think that's like real, but even they are constrained by reality. And a couple of realities started to bite quite quickly. One was bond markets. So, the US has got a lot of debt. They have to pay interest on that. When the interest expense starts to go up, that isn't just an economic issue, that becomes a political issue quite quickly, because they're spending more on interest payments than they are on the military, on retirements and so forth. So, when we say the bond market started to sell off, that isn't just kind of a boring economicsy thing. That has real political implications. And back to April, when the bond market started to get the heebie-jeebies around US policy direction, President Trump, I think, sent out Secretary Bessent, the guy who runs kind of the financial side of the US administration, out to soothe the markets. So it turns out they were constrained by the bond market, which again for markets is quite encouraging. The other thing I'll say just quickly on the US-China relationship, again, I believe them that they are sincere in trying to have a very deep conversation with China about the nature of the relationship and all of that. But for now, the US and China economically are something like a married couple. So they're bickering in public, and it's always a bit embarrassing when you go to a restaurant and the table next to you is a married couple bickering in public. You'd rather they kept it in private. But the US and China, they are doing this, or the US side, I guess, is doing this on Twitter, which is a bit kind of new and different. And that's going to continue, by the way. But the interlinkage between the US and China is so deep that they kind of have to get along, at least to some degree. So I think the lesson of April, lesson of 2025 rather, is even when things get very, very spicy, try and stay invested. And specifically this year, what we've learned is the US administration, while, again, I believe them, they're sincere in trying to redraw many different parts of the economic political map, they have to do it at a pace that's kind of realistic, and they are constrained by important things, including the bond market. And I think the story of 25, I'll come to AI shortly, but the story of 25 has been AI, 2025 has been AI, and the realization that the US administration are serious, but they are constrained by reality, and therefore they can't go too kind of aggressive, and the market's been really reassured by that. So, Aaron, from our perspective at BlackRock, that's kind of the story of 2025. Again, the riskiness of being so-called risk-off is something that really came through to me and to us loud and clear.
Yeah, and as I reflect on 2025 as well, Ben, you think back to that first week in April and so much noise and media and it just everyone worried and we ran a webinar like this at that time, and it's been the most watched webinar we've ever done. But that same message, and I'm glad you said that, and reflect on the point around staying invested is important, because that was exactly the message we gave, that times like this pass, they work through, and some normality inevitably returns to markets and the world. So, and that indeed happened. And it happened quite quickly, actually. So when I reflect on the year and what it all meant for investors in New Zealand, I look across the returns in 2025, and the first thing I notice is that all asset classes we monitor and invest in are showing positive returns. But also the span of returns is quite noticeable this year. So getting asset allocations right has once again proven to be critically important and something that we keep talking about. Most of our investors are in diversified funds, so getting those asset allocation decisions is critically important, and that was proven out this year as well. So for New Zealand investors, having some exposure to emerging market equities has been very effective. That returned for New Zealand investors around 26.5% from the start of the year through to end of November. Global equities also were strong, around 17.5% up to the end of November. Listed infrastructure, the approach that we've taken to listed infrastructure has delivered around 16.5%, which is a tick over 5% more than a pure passive approach. Australian equities have done a bit over 8%, whereas New Zealand equities have been pretty weak relative to the rest of the world at 3.5% through the first 11 months of the year. But bonds and cash are all positive. And we've been rewarded for investing into inflation-linked bonds and high-yield bonds, which have been part of the BlackRock views in the past. So great to be able to get on and have some exposure to inflation-linked bonds and high-yield bonds, which have outperformed the traditional bond exposures for Kiwi investors. So when you pull all this together and look at a diversified fund performance, we've done very well this year. An investor into the AMP KiwiSaver Balanced Fund has achieved a return of 10.35% over the last 12 months, and that's after fees. The KiwiSaver Growth Fund has achieved a return of 12.28% in the last year after fees, and even conservative investors returned 6.27% after fees. So, some healthy returns. It's been a continuation of a good few years, and later on I'll talk about how these returns stack up relative to our competitors in New Zealand, which is also a really positive story for AMP customers. So, Ben, a strong 2025 for investors. And as I said, actually a strong past few years for investors, but that's in the past, and we're all keen to get the crystal ball out and talk about what you're seeing for the future. And now, for context, for everyone listening in who hasn't followed one of these discussions in past years, every year the BlackRock Investment Institute publishes an outlook for the next year. It's always structured into three key themes for the year ahead. But I'm pretty sure you're also going to make mention of mega forces along the way, Ben, which are longer term structural changes going on in the world. So have I laid that context out well for you to talk about your views for 2026?
Beautifully, Aaron. Yeah, ideally. So thanks for teeing me up so nicely. And yeah, it's a megaforce world, and that's like a big deal, we think. So I'll clip through a couple of slides, if that's okay with everyone on the call, just to kind of lay out our kind of core premises and our conclusions. These are our megaforces. And a little bit like Andrew Lloyd Webber's love, we think they change everything. So we really try and keep these front and center, as I mentioned earlier. Like, it's a crazy world, for sure. But I've got a wife and 4 kids, so I have my 5 kind of domestic megaforces, photo behind my screen, and these 5, and they rank roughly pari passu in where I think about my professional and personal life. So stay close to your core convictions. Don't get whipped around by, for sure, what is going to be, again, it's going to be a wild year, right? That is the only thing I would guarantee for 26 is there's going to be news flow and a lot of it. So just try and stay close to what we really, 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 really believe. And these 5, I won't go through them in detail here. We don't have the time, but these 5 are front and center for us. So we, again, try and keep them like literally here as best we can, because it is a confusing world. Move to the next slide, please. So those megaforces have been around. We still think they're important. By definition, they're long lasting, so we don't chop and change those too much. But obviously, we want to make them more up-to-date and nuanced and specific to, for example, the year ahead. So to do that, we're leading into 3 big themes for 2026. Firstly, micro is macro. It's a really interesting world for many reasons. But normally when you're looking at equities, right, you're investing in a basket of companies. It's really interesting for those companies, but the implications for the world are like irrelevant, right? Normally. But today we've got whatever the number is, 10 or maybe a dozen AI super companies, the big American guys, some of the kind of technology companies in Asia, whatever. But it's like 10 to a dozen companies, and they're so huge, and the kind of capex spend is so vast that they are actually macro relevant. So the AI, you'll have seen headlines, they're spending lots of money. But seriously, they're spending lots of money to the extent that the capex spend from a handful of big American companies is now already showing up in American GDP statistics at a relevant kind of level. So the micro, meaning company level analysis, is now extremely relevant to the macro, be that in terms of GDP and hopefully down the track, productivity gains. It's a magical technology, is going to make us all much cleverer, and maybe even disinflation. So theme 1, micro is macro. To understand the macro, you've got to take some view on the AI hyper boom, whether you want to or not. They're just so huge that they are relevant beyond just kind of their share price. They're relevant for the economy, the global economy, by the way, and global markets because of their heft. Secondly, leveraging up. They've got loads of money, these companies. They're making loads of money. We're all addicted to social media or whatever it is. So they've got lots of cash flow, and that's allowing them to spend their own kind of internal money to buy chips, to build the data centers, all of that stuff. But they are the scale of investment is so huge that they're having to dip their toes into bond markets now to raise debt. That's going to continue. And again, the scale of these companies is so vast that that's going to make the whole economic system more leveraged. And by definition, a lever makes everything a bit more fragile. You know, a lever, a relatively smaller input, the longer the lever, the bigger the output. So a more leveraged economy means, for good or for ill, relatively smaller kind of news flow or events can have a disproportionately larger impact. And that's the kind of economic shape that we're moving into. Thirdly, and maybe my favorite, I mean, they're all my favorite, obviously, but thirdly might be my favorite, diversification mirage, which is a bit of a mouthful. So let me explain what we mean. In the olden days, you could just be like invested in maybe a simple equity index and a simple bond index, and you were good. Now, with this fracturing world, geopolitically, economically, and very differentiated performance amongst sectors, basically however you cut the cake, it's not a simple risk on, risk off world. So we think all of us are going to have to work a lot harder to have a much more kind of specific approach to exactly what risk we want in the portfolio. And that's going to have to be a lot more kind of intentional and deliberate. Do you believe in AI or not? Intelligent people can disagree on that, but that's like a very specific choice you're making. Whereas if you just think you're in, let's say, US equities, and you think, oh, I'm really diversified because it's 500 companies. I mean, not really. I mean, if you think about the scale of the AI mega companies in the US, if you buy the S&P 500, if we're honest, it's kind of a big bet on AI. And again, maybe that's fine. We're still pretty bullish AI, so we're happy to make that bet, but it's not kind of a diversified holding. It's actually an active bet on artificial intelligence. And from our perspective, when we're thinking about portfolios, achieving the right level of risk and return, we all need to be mindful that diversification is a bit more hard to come by than it used to be 10 years ago, let's say, before COVID, when, with hindsight, the portfolio living was relatively easy. Just going to go into a bit of detail now on artificial intelligence, because it is, I think, like the story of our time. So go to the next slide, please. Just want to observe on the left panel here, what this shows you, the straight line going bottom left to top right, is trend growth in the US, real GDP growth, and it's 2%. And what's interesting is this is over the last 150 years. You can throw some pretty big stuff at the US economy. You can create electricity, the internet, you can have a world war or two, and trend GDP is 2%. So like, before we get to the conclusion that AI is definitely going to transform like the nature of the US economy, we just should be aware that like, maybe, but that has never happened, or not in the last 150 years. And we've had some pretty big technological discoveries and global events which have occurred over that time. And ultimately 2% has been, for whatever reason, has had such a gravitational pull that line, sure, it wiggled around, but it's kind of 2% as a pretty firm trend line. So getting away from that is not a trivial kind of claim. Go to the next slide, please. Furthermore, I guess what I'm trying to do is I'm trying to take the fun out of AI, right? AI is amazing. I use it every day across every dimension of my life. But as investors, we need to be more sober and focused on, boring realities, because that's life and seems a more prudent way to invest. We can do excitement maybe, in the bar later. That's fine. But in this conversation, we want to be focused on investment opportunities, risk and reward. And what's quite interesting on the left panel here, this shows you the kind of red line shows you forecasts on how much demand for AI there is going forward. And it's a lot. What's super interesting, I think, about that left panel is the black line, or the darker line at the bottom, shows you how much supply of AI going forward there can realistically be, given the physical reality of there's only so much power, there's only so many chips, there's only so much data center. So the punchline is the demand kind of hopes and dreams are here, but the reality of how much the world can provide is much lower. So that's just an interesting kind of pause for thought in terms of the AI super boom. We're on board, by the way. You know, we believe this is a kind of hinge moment in human history. But again, we're going to have to navigate reality, and reality can be a bit clunky. So on the right panel there, the red dot, the kind of fiery red dot, is our base case for US growth. And our base case is still that nominal growth, the x-axis is going to be like 4.5%. So that's the 2% real growth I talked about on the previous slide, and maybe 2.5% inflation. So for now, we're still saying that the kind of the paradigm of the last 150 years is likely going to hold because AI is constrained by there's only so much electricity and so forth. But you know, we are aware that AI has the potential to create the pink kind of dot there, the potential AI productivity boom. So that's the good outcome of, you know, brilliant growth, abundance, productivity, disinflation. We're not quite there yet, but we're not blind to the possibility. There is some chance of that, and the market's going to reflect that ahead of time. So that kind of upside risk, I suppose. So, you know, the base case is pretty good, by the way. You know, the US clipping along at 4.5 is not bad, but the risk, it seems to us, is skewed to the upside, with AI potentially driving like an amazing, hopefully, let's go for that one, good outcome. So on the next slide, we are bullish. And the reason we're bullish is boring earnings, right? So again, AI conversations can kind of turn, you know, magical quite quickly. And then that's fine, right? That's run, that's fun. But at BlackRock, we try and stay focused on fundamentals. And these companies are making lots and lots and lots of money. And we think that's going to continue. So on the right panel there, we show you US earnings we think are going to grow by more than 15% for each of the next 5 years. That's our view, but we want to, you know, fess up and be very transparent that that's quite unusual, actually. You know, if you look over the last many decades, to achieve 5 consistent years of more than 15% growth does not happen that often. So it's our view, but we want to, again, be transparent with all of you that that is like historically unusual, and we're okay to embrace that. But I guess it does make us a bit appropriately nervous that we are talking about a slightly different scenario looking forward. Just a couple more slides. Hang in there, nearly there. Next slide, please. This is my point around diversification. So I won't go through this in too much detail. I'll just say that it does seem that having a more active approach to investing is worth thinking about. Like the opportunities, as I mentioned, they call it dispersion, like the difference in performance between, let's say, the tech sector and another sector is really wide at the moment. So if you have the kind of skill, which is not trivial, by the way, but if we have the skill to kind of benefit from that differentiated performance, it feels like a particularly good time to be thinking in that regard. Last slide from me. Go to the next slide, then I'll shut up. These are some of our kind of big strategic views. What I would say is very much coming back to where I started, the importance of staying invested. So again, you know, think about what are your financial goals. Have a portfolio in consultation with your advisors, obviously, that makes sense, and then really try and stick to your core convictions around those as best we all can. Aaron, let me pause there and pass it back to you, please.
Thanks, Ben, and yeah, that's a great set of thoughts around what we need to be thinking about. And this time of the year and the start of next year, we move into our phase of thinking about where we position our portfolios. We do that, you know, on an annual basis. We look at our allocations. We have some pretty deep conversations with BlackRock, and I know the investment institutes views and are very much foundations for thinking about how we move ahead and how we position portfolios. So we do take a strategic view. So we're looking out longer. So those strategic views are really important to our thinking, and that'll be worked through in the first quarter of 2026 to position portfolios accordingly. And that's kind of our active ad to try and make sure that we're regularly looking at the portfolios and positioning them as best as possible. Now, Ben, while I've got, there have been a lot of questions submitted from people dialing in to listen to this, and There is over 120 questions, so I clearly can't cover them all, but I want to capture some of the key themes of questions and ask some that haven't been covered in your outlook. The questions around AI and technology dominated the submissions that have come in, and so many have asked about it. The mention of tech bubbles, possibly because the media has been making this noise for a while now, and I think you've talked about what you think about the future of AI and the amount of capital being invested in this area. But maybe in simple terms, why do you think this is not a bubble, and why is this different to the tech wreck of the late 90s and early 2000s, which are probably what people relate, what they think the environment's looking like?
Totally. No, this is, I think, like the key question of the moment. So let me address it directly. Firstly, I really feel this is a different situation from the late 90s. If you're old enough to remember that, and if you weren't, I can tell you, like a lot of those companies didn't make any money, right? So they were just a dream. And maybe the dream could have come true in 15 years' time, but they weren't just making any earnings. Some of them weren't even making any revenue. There was literally nothing there in terms of like money. There was a thought, but there wasn't. These companies, we can have a reasonable conversation about valuation. We still think they're quite attractive, but like there's definitely something there, right? So in terms of the revenue generation for these big AI companies, it's a lot, and cash flow and earnings. And where we still feel conviction is they continue to surprise positively, meaning, almost every quarter, it seems like everyone is having to revise up their forecasts in terms of how much money they're making. So for us, the AI story actually is kind of, again, my job is to take the fun out of everything. And I think we could do that with AI. It's just a very boring, it's not, but like, let's pretend it's a really boring, fundamentally driven story. I think that bit's true. It's not boring, but it is fundamentally driven. This is like revenues and cash flows and earnings and positive momentum as the demand for this technology continues to be astonishing and positively surprising in terms of raw money. So that is like I think I can say a total difference from where we were in the late 90s. And one other kind of related nuance, the other thing in the late 90s was we had this phenomenon called dark fiber. So this was fiber optic cables that were stuck into the ground, and we probably got a bit carried away because at some stage, I don't remember the number, but like 90-something% of those fiber optic cables were not being used, and we called that dark. So that was the dark fiber phenomenon. And I think pretty clearly, looking back, obviously 25, 30 years, we got a bit over our skis, we did a bit much digging too fast, and we had like a massive excess of the fiber optic cable versus what was actually required at that time. So that was the dark fiber oversupply problem. If you look at the equivalent today, it's GPUs. It's these very clever chips that underpin the kind of silicon thinking machine. And what I can say categorically is there are no dark GPUs, right? These GPUs are running white hot. And the problem is, if there is a problem, is there's not enough of them. So again, this is just a radically different situation. Have we overspent, created too much supply? Fiber optic cable in 1999? Yes. GPUs in 2026? I don't think so. And for now, again, it looks like the problem is if there is one, is insufficient supply, which is why the big companies are still pouring money into this ecosystem to try and catch up with demand. So for now, Aaron, we ask this question all day, every day, right? So we're watching with both eyes. But I think for now, we can say reasonably comfortably that as we sit here today on a valuation basis and on a, do we actually need the underlying thing basis, both of those still look pretty okay, even positive, we would say, looking through to 2026.
Perfect. You touched on energy use. Any insights in the view on how the world's going to deal with that, and how do we do that in a sustainable way?
We're going to have to build. So I'm here in Abu Dhabi, and I can see the AI revolution out of my window because AI, again, it seems magical, but you can actually stub your toe on AI, right? It is a physical thing, and the thinking machine. Much like me and you, Aaron, you more than me, as a thinking machine, we need a symbiotic relation with energy. You don't just come as a brain in a vat. You need the the energy ecosystem. Maybe my metaphor is a bit weird, but it's true. So humans, we use about 25% of our calories for thinking. The silicon brain, again, you can't just have the chips. It comes as a package. So what we're seeing now, I think, is a very significant ongoing surprise to electricity demand all over the world. And simply put, there is a real concern here that there isn't enough. So there's going to be a scramble, I think, for electricity. That's quite bullish for utilities companies. It's also quite bullish, maybe, you know, one layer down, all the way down to copper wiring. So I think, you know, being bullish AI, we are bullish AI, but again, we need to be a bit careful. Exactly what does that mean? For sure, it means the big American companies, but it also means some of the Asian names. And actually, it could even mean different sectors like utilities, given the power, the electricity that's required, are the right side of the AI super boom. And again, you could even extend that thought into the physical copper wiring that's going to be needed to generate the electricity, or rather to transmit the electricity, because that's how we get copper from A to B, from where it's created. So AI, we are bullish, but we want to be a bit nuanced as to exactly what that means. And power, I think, is pretty... I'm nervous to say it's top of the list, but it's close to being top of the list as to an obvious area which is going to see prices rise, which to pick up a hint in your question, I think will have political kind of consequences, just by the way. And that's something that societies are going to have to work through, how we balance electricity demand for the thinking machines versus, you know, normal people. But I think as investors, the opportunity is to help, you know, provide money into funding the creation of more energy, more electricity, which is absolutely, I think, going to be needed by this AI hyper boom already, and likely to continue, maybe even accelerate in the years ahead.
The opportunity is not just in the chip makers or the Apples and the Amazons and Alphabets. It's the whole economy this is impacting. Let's change tact a little bit, because we've talked a bit about technology. Let's go to geopolitics. There's a question: will an end to the Ukraine-Russia war boost market sentiment from a bullish perspective? And if so, in which areas specifically?
Yes, and obviously fingers crossed for that. Just briefly, you know, as a human, I'm an investor as well, but as a human, like, we're all optimistic, I guess, for a much better outcome. Obviously, it's been horrendous for what seems like much too long. So you know, fingers and toes crossed. To the actual question, the immediate implication, I mean, there's many, but I'd have thought the immediate implication would be for energy prices specifically. So, you know, Russia's what's the next word here? Difficult relationship with the family of nations, let's say, has meant their oil production, which is very huge, has been made much more complicated over the last year or two or three. Any step in the direction of normalization seems too strong, but let's just say any step in that direction, and a reintroduction of Russian supply, even a bit, given the scale of that country and their kind of capacity in oil, many other commodities, by the way, would be a very significant positive supply surprise, meaning there'd be more available energy, fertilizers. Again, Russia does many different bits and pieces, which I guess would help energy prices continue to be stable, and if anything, a little bit capped. So in turn, that would be great, I guess, as a kind of macro phenomenon, potentially taking some of the heat out of inflation, which continues to be problematic, I would say, in the US and elsewhere. So, you know, of course, most importantly, as just a citizen of planet Earth, we're all optimistic for that. With my tie on and with my work voice, I think the implications most immediately would be felt through the energy complex, and a kind of even a marginal, if you like, re-onboarding of Russian supply would increase the kind of amount of available energy that's out there, which again should help dampen energy prices, which maybe not so good for energy producers, but in aggregate, the world is a user of energy. So on aggregate, that would be a good thing for the global economy. So yeah, fingers and toes crossed for that one, I guess, Aaron.
And also on geopolitics, because that's becoming an increasing concern everywhere. What potential scenarios could play out in 2026, and how might they affect markets? And the second part of this question we got was, will the US pull back from its tariffs?
I think, if I may, I'll take the second one first. No, I think they love it. I think tariffs have now become like normal. It's a bit like, monetary policy. 15 years ago, we all thought QE was unimaginable. Then it became unorthodox. Then it became orthodox. And now it's just like bread and butter. And I think a similar journey for tariffs over the last 10 years. Don't forget, it's been 10 years, right? Trump 1.0 was 2016. And we're all, time ticks on, right? So suddenly we had Trump 1.0, Biden continued it, right? So the US administration actually had maybe a surprising amount of continuity through the Biden administration, at least in this regard. So I think, Aaron, I think they're here to stay. And I think what's very interesting, there's many interesting things, but also we've got this blending of economic and foreign policy. So again, in the olden days, which is only like 5 minutes ago, but in the olden days, they were perceived to be very distinct, right? You'd worry about your economy and you'd have, foreign policy pretty much unrelated. Now, the absolute go-to from the US administration as like an opening bid is we're going to tariff you a lot or a little bit, or like that is the opening kind of salvo in all of their diplomatic conversations. Be that with foes or even with allies, right? So, Europe, UK, nobody is exempt from that conversation. So, no, I think the American administration are greatly enjoying the broader usage of tariffs for generating revenue, maybe for righting what they perceive to be historic injustice. All of that. But it's also just quite fun in terms of creating leverage for the US administration to get outcomes they want, be that in India, be that in Venezuela, be that in Australasia. It's just so I think for now, I think this is now another kind of normalized part of the policy toolkit, which again, 15 years ago, you might have thought I was joking, but here we are. And I don't think that genie's going back in the bottle anytime soon.
All right, cool. Maybe I might have to answer this next one. Is AMP investing into private markets? Yes, we are. We've already made a couple of small investments via our diversified funds and looking to invest more. We've focused those investments on direct infrastructure as part of our strategy, specifically in the areas of energy, transport, water and waste, and digital. So it sort of aligns to a lot of the things Ben's been talking about. We do this with our investment partner, and we're building a portfolio of large, high quality, real infrastructure assets around the globe. And particularly important for us is that they have a decarbonisation focus, which is part of our philosophy. Ben mentioned AI and data centers earlier, and the need for the energy supply of those, and that's something we're going to be part of through the small piece of our diversified funds. So yes, very very keen on the right allocations to private markets, but particularly through direct infrastructure. Next question, Ben, this is an interesting one. Are you expecting turmoil in the markets next year with the increasing possibility of social unrest and readjustment?
I think the Chinese have got this phrase, may you live in interesting times. And I think that's going to continue, right? Things are not going to be dull. And some bits of that are good, like the AI revolution is kind of a magical moment in human history. So that's in the round quite positively exciting, I think. And you are seeing it seems to me, wherever I go in the world, the political conversation is something like local versus global. So there's different versions of that story, but it seems to me, I shouldn't pretend I know as much about New Zealand as you guys, obviously, but wherever I go in the world, the conversation has moved from the traditional kind of left versus right conversation towards a local, nationalist, patriotic, whichever your preferred branding is here, and a kind of globalized, like we should all benefit from trade. So I think that's going to continue and is a naturally kind of fractious conversation with strong feelings on both sides. So again, it's not going to be dull. Do I think there will be tumult in markets? I mean, hopefully, in a way, right? So we want to think about, again, if you think about April 2025, with hindsight, I guess that was the opportunity, right? I mean, there's a few wrote large, but again, if we can stay focused on what we believe to be true, like really focused on that, and then if we have, a wild tweet or something unexpected happens and you get a market sell-off, that's the moment maybe when we want to be thinking about checking in with our own portfolio and saying, hey, we're tariffing penguins, but does that impact AI? Not really. And some of these AI stocks have sold off. I'm talking about April 2025 here. So if we could see a repeat of that in 2026, like that's not necessarily a bad thing. It feels a bit unsettling in the moment, that's for sure. But again, as investors, those are the moments that we should be positively minded. Again, another kind of market cliche is we should be greedy when others are fearful. So those moments when the markets gets the heebie-jeebies, if you can, again, it doesn't feel like it in your tummy, but with your brain, if we can just kind of be forward thinking and thinking, okay, maybe this is an opportunity. We've had a sell-off. That's kind of not great because my net worth is lower than it was, and I don't like that. But actually, is there some kind of core convictions I can lean into given this sell-off? I think is the mindset that over time can pay dividends and get us all where we want to be in terms of portfolios doing what we need them to do.
Any predictions on sort of interest rates? It's a very broad question there, but how are you thinking about interest rates around the world and how that might flow on to our investors?
Tricky still. So the problem we've got, at least the way we think about things, is in the US. I mean, you asked a global question, but the Fed is the world's central banker in a way, right? So I'm going to go there if that's okay. The challenge they've got is inflation's too high. So the Fed has a dual mandate, and it's very complicated for them at the moment because the employment side of their mandate looks a bit weaker, right? So that would suggest they should be cutting interest rates. But on the other side, inflation's too high, which suggests they should not be cutting interest rates. So the Fed has got a genuinely complicated job through 2026 to kind of calibrate how they balance the conflicting directions of their dual mandates. So we think they are obliged. I mean, it's not just our view, right? They have a mandate, which means mandatory, to do both, including inflation. And the problem with inflation is, in round numbers, it's already like 3% in the US. Target is 2. Ben checks notes confirmed. 3 is higher than 2, right? So 3 is too high. And potentially, we've still got some of the tariff implications to work through, which means there's some chance that 3 number could actually be tickling higher over the next several months. So we think that it's not obvious the Fed can be like cutting a lot, and that being a big kind of tailwind for risk markets as a general statement. A bit, right? Because as I say, the employment market does seem a bit weaker, so a bit. But as investors, we think that it's going to be necessary to really think about a specific kind of tailwinds and focusing on those mega forces that I keep going on about. So just keeping those tailwinds in your mind and not being like just fully relying on the Fed to do all the work for us and having a rising tide lifting all boats. So, I mean, we are quite positive. We think the Fed can do a bit, but we're probably going to have to do a little bit of work on top of that to make sure our portfolios are aligned with those structural tailwinds, again, rather than just relying on the Fed to do all the work for us.
And New Zealanders are going to feel the impacts of that because we borrow money from offshore. So the cost of that borrowing is going to go up if the Fed puts rates up. That's the simple reality. Is there any way for an index manager to lessen exposure to the Mag 7? Maybe that's one for me. There are. But given the outlook presented by Ben, any attempts to do this would be making, I think as Ben said, large active calls, and they're not large active calls that we'd be prepared to make. Some of our competitors have been underweight the Mag 7 or the Magnificent 7. So that, Apple, Microsoft, Amazon, Alphabet, Meta, Tesla, and NVIDIA are your Magnificent 7. Some of our competitors have been underweight or haven't owned those for over a year now, and they've significantly underperformed our funds. So an index manager could sort of use a different type of index, more of an equal weight index. But I think you need to step back a bit and consider whether technology and AI is something that impacts these companies, or does it impact all of us? If there should be an AI theme stumble, which we talked about earlier, then you might not get the diversification away from this risk as much as you expect. And I think Ben touched on that as well. So, it's AI is everywhere, technology is everywhere. So taking a bet like that is pretty risky. Probably need to start finding the end of this conversation, Ben. I just want to get a view on New Zealand because we've got a lot of questions around New Zealand interest rates, New Zealand housing, and you're probably not looking at those on a daily basis where you are. But I do know, and remember you telling me that you played a year of rugby in New Zealand, in Auckland. So at least hopefully one or two people are dialing in to see you again. But when you're thinking about New Zealand from a global perspective, um, what how does New Zealand look from where you sit, looking at the world in totality?
It looks beautiful. Yeah, you're right. A very happy 6 months, proving I was definitely not good enough to to make it in any way, shape, or form in high level rugby, but a beautiful experience along the way. So I think when the world looks at New Zealand, what do we see? Obviously, we see a stable, developed market ecosystem, legal infrastructure, and so forth. And we shouldn't take that for granted, by the way, right? Again, I'm all over the world in many markets, including emerging markets, and that's not as common as maybe we would all like it to be. That would be the first thing. Second thing, I suppose you touched on it actually, Aaron, a bit earlier, the focus on the overlap between, let's say, sustainability and infrastructure. So that's a really a kind of an investment theme that global investors are very, very, I think, in general, interested in, is thinking about these longer term, where can I find a beautiful return stream, invested into a piece of infrastructure. And infrastructure can mean many things, like from toll roads to data centers and everything in between. But in the round, what we're really trying to access is the return stream. And I hope that that's a very stable, predictable, inflation-beating return stream. And from a New Zealand perspective, it's quite common that there's also a sustainability element to that, which again, for many global investors is very, very attractive. So I would summarize by saying, you're right, New Zealand is, with all respect, is not the biggest economy, in the world, but the strengths, I think, are very real and attractive. And the investment opportunity, I think, aside from being a diversification play in some ways, maybe because New Zealand isn't so directly itself geared into the AI mega boom, so diversification is useful in that regard. But that infrastructure requirement and the kind of funding that's going to be needed to drive New Zealand society's infrastructure requirements over the next many years, private capital maybe can be helpful in that, right? So the dream for capitalism is it can be win-win, right? We're providing money, getting a fair return, so people can afford their pension, which seems reasonable to me. And, New Zealand or other countries are getting the infrastructure they need, be it schools, hospitals, toll roads, or the AI stuff. That seems to me to be a nice partnership. And I do think, whether it's New Zealand or more generally, I think that kind of partnership is becoming more and more commonplace all over the world. So I think we are continuing the normalization, if you like, of private assets as part of a not 100% obviously, but more than 0% of a well-diversified portfolio. I think, Aaron, that's going to continue. I think that's going to continue.
Right. We have run out of time for more questions. We've got through more than I thought we would. But regardless, as a reminder to anyone that has further questions, to talk to your advisor or any of the team at AMP if you'd like any help with your savings, retirements, or investment funds. They're there to help you and answer all questions. A couple of closing points from me. I mentioned before about returns and how our funds have performed relative to our peers. It's been a very special time for us since we did a complete overhaul of our investment approach in 2021, and that's when we partnered with BlackRock to bring global investment expertise to the New Zealand market. People like Ben and the rest of the enormous team at BlackRock that bring that global insight and expertise to New Zealand has been super special for us. We measure ourselves in KiwiSaver with diversified funds against major peers, and that's the largest balanced funds in the market. That's what we use as a yardstick, and they're the biggest, and it's certainly our biggest fund as our balanced fund, and as at the end of November, our balanced fund is ranked number one over the past 3 years in the group that we always measure ourselves against, which is a pretty amazing result we've sort of come across in the last few days, and that group includes all the big players in the KiwiSaver market. ASB, BNZ, Simplicity, Generate, Westpac, Milford, Booster, ANZ, Fisher Funds, and Mercer. So, but that's the group we measure ourselves against, and so we're number one over the past 3 years now, which is something we're super proud of as an outcome for our customers. 5 years ago, we were struggling and made some big changes, and those changes are clearly paying off for our customers. So, and I think soon our 5-year ranking will lift from where it is today in third place, and I think that'll be going higher as well. So, being consistent with our returns, sticking to our philosophy, and bringing the best global expertise is working very, very well. So, um, on that note, thank you to Ben for your time today and your wisdom and sharing those insights with our customers and anyone who dials in to listen. Thank you to all of our customers for your loyal support and confidence in AMP to help you with your savings and investment goals. Again, please talk to your advisor or AMP if you have any further questions. And just want to wish everyone a safe and Merry Christmas and a prosperous new year. And same to you, Ben. Thank you for joining us. It's been a brilliant update.
Thanks, Aaron. Good to see everyone. Hope to see you soon.